Hello students, welcome back. This is Mrs. Mercado. This is a continuation over chapter 22, which deals with budgeting. Now this problem that I'm going to be going over deals with the cash budget. Okay, I'm going to jump over to the problem that we're going to be covering. This is problem 22.5a. And this particular problem has a lot of information. Okay, a lot of information is provided. Some of the information you're going to need, other you're not going to need. They're just putting it out there so it can throw you off. And a lot of the information is calculations that need to be done to be able to calculate the actual figures. So it needs to be broken down even further. Okay, so the problem reads: the controller of Bridgeport Housewares instructs you to prepare a monthly cash budget for the next 3 months. And we are being asked to prepare a budget for September, October, and November. Okay, you are presented with the following budget information. So they give you the sales amount per month, the manufacturing costs, the selling and admin expenses, and the capital expenditures. Okay. Now, it says here that the company expects to sell about 10% of its merchandise for cash. So, of the sales that you make in September, October, and November, 10% are going to be in cash. So you're going to have to figure out how much of the sales are cash sales. That's 10% of your total sales. Okay. Of any sales on account, which is anything remaining, so 10% are cash sales, 90% are sales on account. Of the 90% sales on account, 70% are going to be collected the month following the sale, and the remaining the following month, the second month following the sale. Depreciation, insurance, and property tax expense represents $50,000 of the estimated monthly manufacturing costs. So they give us the manufacturing costs here. $50,000 is comprised of depreciation, insurance, and property tax. Okay. Now they're telling you here that the annual insurance premium is paid in January. Okay, and the annual property taxes are paid in December. Okay, because we are preparing a cash budget for September, October, and November, this information is really not relevant to us because the insurance is going to get paid in January, and the property taxes are going to get paid in December. So we are only interested, what are we going to pay in September, October, and November? Okay. The annual insurance is paid in January and the property taxes in December. Okay. Of the remainder of the manufacturing cost, whatever we have left over, 80% are expected to be paid in the month in which they are incurred and the balance in the following month. Okay. So we're going to have to make some adjustments to our manufacturing costs by deducting our $50,000 estimated monthly manufacturing costs, and then whatever we have left over, 80% is going to be paid in the month it is incurred, and then 20% the following month. Okay. Current assets as of September 1st include cash of $40,000, marketable securities of $75,000, and accounts receivable of $300,000. Okay, and this is very important. This is money that as of September 1st, someone owed you $300,000. $60,000 is from the July sales and $240,000 from the August sales. Sales on account for July and August were $200,000 and $240,000 respectively. Current liabilities as of September 1st include $40,000 of accounts payable incurred in August for manufacturing costs. All selling and admin expenses are paid in cash in the period they are incurred. An estimated income tax payment of $55,000 will be made in October. That is very important because we're paying those $55,000 in October, okay, which is one of the months that we're being asked to prepare a cash budget for. Bridgeport's regular quarterly dividends of $25,000 is expected to be declared on October and paid on November. Okay, also impacting the information or the months that we are doing our cash budget for. Okay, management desires to maintain a minimum cash balance of $50,000. Okay, instructions: prepare a monthly cash budget and supporting schedules for September, October, and November. So this is a setup of my cash budget. I've got the name of the company, which is Bridgeport Housewares Incorporated. This is my cash budget, and this is for 3 months ending November the 30th, and it's for September, October, and November. Okay. So the first thing that we're going to deal with in preparing our cash budget is our cash receipts. How much money are we anticipating collecting during September, October, and November? Okay, so we're going to have our estimated cash receipts. And then we have two sources of cash receipts. Okay, we have cash sales, and then we have collection from accounts receivable. Okay, those are the two sources. Either you sell something and they pay you right there and then cash, or you sell something on account and then you collect at a later point in time for those sales made on account. Okay, so let's worry first about my cash sales. Okay, so your cash sales, it says here that the company expects to sell about 10% of its merchandise for cash. Okay, very important right here. Okay. That is super important because we know that of our total sales amount, okay, 10% are going to be cash sales. So I'm going to look at how much sales do I have each of the months. I've got 250, 300, and 315,000, and my cash sales are going to be 10%. Okay, so cash sales are 10%. 10% of sales. Okay, that's what. Oh God. There we go. 10% of sales. That's what it's going to be. Okay, so to calculate my cash sales for September, I'm going to get my 250,000 and I'm going to multiply by 10%. Okay, and that gives me $25,000 for September. For October, I've got 300,000 times 10%. That gives me 30,000. And for November, I've got 315,000 times 10%. That gives me 31,500. Okay, that is the easy part. Now, the collection from accounts receivable, that is complicated. Okay, so in order for us to be able to identify how much money are we going to collect in September, October, and November, we need to do a separate schedule. Okay, so what I've done down here is I've done my computations for, oh, and I didn't delete them. I was working out the problem, but let me delete all of this. We need to figure out how much, and maybe I'll just scoot this. Well, no, because let me see. Do I need that space? No, I don't. So let me move that up a little bit. That way I don't have to be scrolling up and down that much. Okay. Okay. So here we go. So I need to do some computations for my collections of accounts receivable. And we need to be very clear on how this works. Okay. Now the problem says that you're going to get your sales. 10% of those sales are cash. Okay. So that means 90% of the sales are on account. Okay. Now that percentage, that 90% the 90% of sales on account, 70% are going to be collected in the month the following the sale, and the remaining the following month, the second month following the sale. Okay. Now, the problem gives us accounts receivable balance. So it says here that as of September the 1st, we have an accounts receivable balance of 300,000. So we have 300,000 that we have not collected in our books. Okay. So we haven't collected that money. And then it says here that 60,000 are from the July sales and 240,000 are from the August sales. Okay, sales on account for July and August were 200,000 and 240,000. So this is very important. On July, I sold 200,000. I had sales of 200,000 on account. On August, I had 240,000 sales on account. Okay. I don't know why I'm getting all of these pop-ups down here. Okay. Okay. So, so this is the information. So we need to do some calculations. First thing we're going to do is, when are we anticipating collecting for those July sales? We had 200,000 of sales in July. Okay, so let's start right here, and I'm going to break it down for you. July sales were $200,000. Okay, and that is given to you right there in the problem. Okay. Okay, let me find it right here. July and August right there. Okay, this is the information that I'm using. Okay, so on July I had sales of $200,000. Okay, out of those $200,000, okay, 70%, okay, 70% are going to be collected in August, and then 30% is going to be collected in September. Okay, so we had July sales of 200,000. 70% is going to be collected the following month, which is in August. 30% is going to be collected the second month after the sale, which is in September. So I am only interested in how much am I going to collect in September, October, and November. Well, for my July sales, I know that I'm going to collect 30% of my $200,000 sales in September. Okay, so I know I had sales of 200,000, and I know I'm going to collect 30% of those sales in September. That gives me $60,000. Okay, now in August, I had sales of 240,000. Okay, 70% is going to be collected in September. Okay, and then 30% is going to be collected in October. Okay, and I'm breaking it down for you down here so that way we can see the breakdown. So I had 240,000 sales in August. Okay, August sales were 240,000. I am going to collect 70% in September. Okay, so for my August sales, I'm going to collect, I had 240,000 of sales, and I'm going to collect 70% of them in September. That gives me $168,000. Okay, and then in October, I'm going to collect 30%. So I'm going to get my 240,000 times 30% in October. Okay, now let's look at our September sales. Okay, now in September, okay, I had sales of $250,000. I'm going to subtract my cash sales. I know I had cash sales of $25,000. Okay, so my actual September sales on account were 250 minus my cash sales of 25,000. That's going to give me $225,000 in sales on account. Okay. Okay. And then from there, I can say that for those 225,000, 70% are going to be collected in October. Okay, and then 30% are going to be collected in November. Okay, so remember, for your September sales, you need to subtract you're going to get your total sales amount, your 250, minus your cash sales, and that's going to give you the sales on account, which is the 225,000. And then the 225,000 is what you're going to split between the 70 and the 30%. Okay, so September sales, I am going to collect 70% in October. Okay, so I'm going to go ahead and I'm going to do the 225,000 times 70% in October. That gives me 157,500. And then I'm going to get the 225 times 30% in November, and that's going to give me 67,500. Okay. Now let's look at our October sales. Okay. My October sales were $300,000. Okay. I'm going to subtract my cash sales for October. They were $30,000 in cash sales. So I'm going to subtract that. And then that's going to give me 300,000 minus 30,000. That's going to give me $270,000 sales on account. Okay. Out of those sales on account, 70% are going to be collected the following month, which will be in November. And then 30% will be collected in December. Okay. So remember, I'm only interested in what are we going to collect September, October, and November. So for November, I'm going to collect 70% of my October sales. So that's going to be 270,000 times 70%, and that gives me $189,000. Okay. The other 30% are going to be collected in December. That is not included in our 3 months that we're analyzing, so we're going to exclude that from our calculations. Now I can get my totals. Okay, so I'm going to add my total for each column for September, October, and November. Okay, so that is how much I anticipate collecting in my accounts receivable based on my sales on account. Okay, so now that I've got that, I can just copy those numbers. I'm going to copy them and I'm going to paste them over here. Okay. So that is my collection of accounts receivable. That is how much I'm going to collect. Okay. Now I can get my total cash receipts. Remember, we're only interested in what actual cash we're either going to receive or pay. In this case, we have total cash receipts, and I'm going to add my cash sales plus my collection from accounts receivable to get my total cash receipts. And I'm going to do the same thing for each of the columns. So I'm just going to get my total for each of the columns. Okay. Okay. So that is what I'm going to be collecting. The next thing we have is we're going to deduct any estimated cash payments. Okay. So these are cash outflows. This is us paying cash for different expenditures. Okay. So the first thing we have is our manufacturing costs. Okay. Now our manufacturing cost is a little bit complex as well. Okay. Just like we have a schedule for our collection from accounts receivable down here, we're also going to have a manufacturing schedule as well to come up with our numbers. Okay. But before we go into that, let's read what it says about manufacturing cost. So we are provided with our manufacturing cost here of $150,000, $180,000, and $185,000 for each of the respective months. Okay. It also says that depreciation, insurance, and property tax expense represent $50,000 of the estimated monthly manufacturing costs. Okay. What else does it say about the manufacturing costs? Okay. It also says, let's see, right here. Okay. Then they tell you when you're going to pay your insurance, which is in January, your property taxes in December. That really doesn't apply because those 2 months are not any of the 3 months that we're analyzing. So those would be monies that would be paid in January or in December. Okay. Now this is very important. Okay. Let me highlight this or box it out. Okay. Manufacturing costs are 80% are expected to be paid in the month in which they are incurred, and the balance in the following month. Okay. Okay. So that is what it says here. Manufacturing costs, 80% are going to be paid in the month they are incurred, and then 20% the following month. Okay. So let's do our analysis, okay? Let's go down here and let's do our analysis, okay? So let's start with September. For our September manufacturing costs. Okay? And I'm going to break it down for you, okay? In September, we had manufacturing costs of $150,000, okay? That was given to you there. They're telling you that 50% of the $50,000 is for depreciation, insurance, and property tax expense, okay? We're going to deduct those $50,000 because those are not going to get paid this month. Those are going to get paid in January and in December. And we're only interested in knowing what are we going to pay with cash in September. So I'm going to deduct those $50,000 from my calculation, okay? So then 150,000 minus 50,000, that's going to give me $100,000, okay? Now, that $100,000 of manufacturing costs, I know that 80% are going to be paid in September, in the month in which was incurred, okay? And then 20% are going to be paid the following month, which would be on October, okay? So, now that I know this, I know that, okay, we can do our calculations for September, okay? Now, before we go there, let's go back and let's read additional information in the problem, okay? Additionally, it says current liabilities as of September 1st include $40,000 right here. $40,000 of accounts payable incurred in August for manufacturing costs. Okay. So, we owe $40,000 of accounts payable dealing with manufacturing costs, okay, which needs to be paid in September, okay? So, we're going to start off with that starting point. I know that I need to pay $40,000 from the prior month. It says those right here, okay, incurred in August. So we're going to pay for those in September. And then payment for my current month's cost. In September, I'm going to have to pay $100,000 times 80%. And then let's see what that gives us. 100,000 times 80%. That's going to give me $80,000. So, in September, I have to pay $80,000 of manufacturing costs, okay? So now I can get my total for September that I have to pay. I'm going to pay $120,000, okay? Now, from my September manufacturing costs, I know that I am responsible to pay 20% in October, okay? So, I'm going to get, okay, my $100,000, and I'm going to multiply by my 20%, and let's see what that gives us. 100,000 times 20%, that's going to give me $20,000. So, the problem says 80% of your manufacturing costs are going to be paid in the month they are incurred, which was the 80,000 here. And then 20% are going to be paid the following month, okay? So, my September manufacturing costs are broken down in two different ways. I'm responsible to pay for those 20% in October. So, that's going to be my balance from the prior month, okay? Now, let's look at our October manufacturing cost. Okay. In October, we had manufacturing costs of $180,000. Okay. I know I need to subtract the $50,000 of my manufacturing costs, which are for my depreciation, insurance, and property tax that I'm not going to pay this month. So then that's going to give me 180 minus 50,000. That's going to give me $130,000 of manufacturing costs for October. Now, out of that 130,000, 80% are going to be paid in October, which is going to give you 130,000 times 80%. And let's see how much that gives us. 130, 1, 2, 3 times 80%. That gives me $104,000. Okay. And then 20% is going to be paid in November. Okay. So then that's going to be 130,000 times 20%. So then that's going to give us 20%, $26,000. So out of my October manufacturing costs, I'm going to pay 80% in October, which is $104,000. Okay. And then I can get my total here for October. Okay. And in November, I'm going to pay 20%, which is equal to the 26,000. Okay. Right there. That's due in November. Okay. 20% is due in November. 80% is due in October. Now let's look at my November manufacturing costs. Manufacturing costs. Okay. So for my November manufacturing costs, I have $185,000. I'm going to subtract my $50,000. That is for my depreciation, insurance, and property tax. And then that is going to give me 185 minus 50,000. That's going to give me 135,000. Okay. Now that 135,000, 80% is going to be paid in November. And then that's going to be 135,000 times 80%. And let's see what that gives us. 135 times 80%. That's going to give me $108,000. That's going to be paid in November. And then 20% is going to be paid in December. I really don't care about December because our cash budget is only for September, October, and November. So I'm only interested in what do I have to pay in November. Well, in November, you have to pay $108,000. Okay. And then I can get my total for my November, which is 134. Okay. So our starting point was the 40,000, which was given to you here. Your accounts payable incurred for August for manufacturing cost. And then you have to do your calculations. Remember, 80% is due or to be paid the month it is incurred. 20% is the month after. Okay, so these are the calculations of what is to be paid in each of the months. Okay, once we have that, we can just copy and paste those numbers. I'm going to copy them. And I am going to paste them on my cash budget. Okay. And this is going to be for my manufacturing cost. Okay. And it didn't work. Okay, right here. Control copy. Right there. Okay. Now, it says less the estimated cash payments. Any cash outflow is going to be in minus, okay? Because we are paying cash for our manufacturing costs. So because it's an outflow of cash, I'm going to put it in parentheses, okay? Now the next thing we have are selling and admin expenses. Now for selling and admin expenses, it says right here, selling and admin expenses are paid in cash in the period they are incurred. Okay, so we need to be very extra careful with the information provided. So selling and admin are paid in the period they are incurred. Okay, so I've got selling and admin of 42,000 for September, 48,000 for October, and 51,000 for November. Okay. Next, we have capital expenditures. We had a capital expenditure of $200,000 on November. Make sure that you put it in the correct month. Okay. Capital expenditure for November. Okay. Then we have some other items. Okay. If we look here, it says that we have an estimated income tax payment of $55,000 to be paid in October. Remember, we are interested in any cash inflow or outflow during September, October, or November, because that is what we're doing our cash budget for those 3 months. So it says here that we are going to pay income tax of $55,000 in October. So we're going to have income tax, and we are paying in the month of October $55,000. Okay. Now, the problem also says Bridgeport regular quarterly dividends of $25,000 is expected to be declared in October but paid in November. Okay. So that is also very important because we're going to pay out $25,000 in dividends in the month of November. Okay. We're going to declare him in October, but we're going to pay him in November. So we're going to go ahead and we're going to do dividends. Okay. And we're going to pay those dividends in November of $25,000. Okay. Now I can get my total cash payments. This is what we paid. This is money leaving the company. Okay. So I'm going to add my total of my cash payments by column for September, October, and November. Okay. Now we can figure out if our cash increased or decreased. If it's a positive number, it increased. If it's a negative number, it's a decrease. So what we're going to do is we're going to compare our cash receipts to our cash payments. Okay, that's what we're going to do. So I'm going to get my $253,000 minus my $162,000 cash payments, and that's going to give me $91,000. Okay. For my October, I got my $259,500 minus $227. That gives me $32,500. And then I've got $288,000 minus $410,000. And that gives me a negative $122. Okay. Then I'm going to start off with my cash balance at the beginning of the month. Okay. Now, the problem says, and this is where we should be highlighting or marking, it says that we have current assets as of September 1st, which includes cash of $40,000. Okay. So we've got cash of $40,000 starting off in September. Okay. So I've got my cash increase plus the cash balance that I had from the prior month. It's $40,000. So I can calculate my cash balance at end of month. Okay. So at end of month, I had cash of $131,000. Okay. That is for September. Okay. Now you need this number to carry it forward in October. That's your ending cash balance for September. That's going to be your beginning cash balance for October. So I'm going to bring that forward. And then I'm going to add my increase plus my cash balance. And that'll give me $163,500. That number will then flow over to the next month. Okay. And then we can add those together. And then that gives me $41,500. So that is your cash balance at the end of each month. Now, something very important that management wanted to do was management wanting to maintain a cash balance of $50,000 on the account. Okay, that is how much cash they wanted to have at all times, $50,000. So I'm going to subtract my minimum cash balance, and that is $50,000 that they want to have available, not use up, in case of an emergency or whatever the case might be. They want to have that $50,000 available, okay, each of the months. So now I can figure out if I have excess or deficient money in my cash account. Deficiency. Okay, there we go. Okay, so I'm going to get my cash balance of $131,000 minus my $50,000. That'll give me $81,000 for September. $163,500 minus $50,000. That'll give me $113,500 for October. And then $41,500 minus $50,000. That will give me negative $8,500. Okay, so I have, after maintaining my $50,000 minimum balance, I still have $81,000 remaining in September, $113,500 in October, but in November I'm short $8,500. I'm deficient $8,500. Okay, to be able to maintain the balance of $50,000 that management want. Okay, so this is my cash budget. Okay, it breaks it down by your cash receipts and then all of your cash payments, and then we're able to balance down here, set up a reserve. The reserve here is $50,000, and then figure out, am I going to be able to have whatever is it that we are being required by management to have. We're being required by management to have $50,000. Even by keeping those $50,000, we're still going to have $81,000, $113,500 in September and October in our accounts, but then we'll be short in November. And the main reason we're going to be short in November is because we had that huge capital expenditure of $200,000. Okay? Now, this is the first requirement, preparing the cash budget, and then we have the two schedules of how we came up with our collections of accounts receivable and our payments for manufacturing cost, okay? Now, the second component is on the basis of the cash budget prepared in part 1, which is what we have right here, what recommendations would you make to the controller, okay? So, looking at the information presented, okay, we need to be able to make some recommendations. Okay, and let me make the recommendations right here. There we go. Okay, so this is my excess or deficiency after maintaining my minimum cash balance. Okay, so we can say here the budget indicates that the minimum cash balance will not be maintained in November. Okay, remember we're short, we're deficient $8,500. Okay, this is due to the capital expenditure requiring significant cash outflows during the month. Remember, we had a $200,000 capital expenditure in November, right there, $200,000. Okay. This situation can be corrected by either borrowing and or by the sale of marketable securities if they are held for such purposes. So if we recall, we have $75,000 worth of marketable securities. You know what? If we are expecting to have that huge capital expenditure, maybe we want to sell those marketable securities in November to help with that major expense that we had there. Okay, that could be a solution. Okay, at the end of September, oh golly, September and October, the cash balance will exceed the minimum desired balance, and the excess could be considered for temporary investment. So we can see here, I'm going to have 81,000 left over and 113,500 left over after keeping my reserve of $50,000 on the bank, okay, for my cash. So that money can be invested to be able to help liquidate that 200,000 expenditure in November. Okay, so those are some possible options we have. Either we invest what we had the excess in September, October, or we sell our marketable securities of $75,000 that we had. Okay, so that is a complete schedule, and that's like a little analysis of what could be done to help correct the deficiency in the month of November. And then we've got all of the calculations along with it. Okay. This is very important that we understand how to prepare a cash budget. Okay, cash is an instrumental resource for all businesses, and they should be able to identify how much cash are we anticipating collecting, how much cash are we anticipating paying, maintaining a minimum balance required by management, and then identifying, are we going to be able to maintain that balance? Are we going to be over or short? Okay, so that is the end for problem 22 5A. Thank you.